Every investor is told the same thing. You can sell your stocks anytime. That is only half true. Today, I will show you exactly what happens if everyone tried to sell at the same moment, and why that almost never goes well. First, you need to understand liquidity. Liquidity simply means how easily can something be turned into cash without dropping its price. For every seller in the stock market, there must be a buyer on the other side. No trade can happen without both. On a normal day, this balance works smoothly. Millions of sellers and millions of buyers trade constantly, keeping prices stable. But imagine one single moment where almost everyone wants to sell and almost nobody wants to buy. That is the exact scenario we are exploring. When sellers massively outnumber buyers, the price has to drop. It keeps dropping until it finds a level low enough to attract a new buyer. This is not a malfunction. This is the market working exactly as designed. Price is simply the meeting point between what sellers accept and buyers offer. There is a real historical example of this exact scenario. It is called Black Monday, October 19, 1987. On that single day, the Dow Jones Industrial Average fell 22.6%. It remains the largest one-day percentage crash in stock market history. More than $500 billion vanished from the market in a single trading session. Investors around the world watched their wealth shrink within hours. The crash began in Asian markets, then spread to Europe, then hit the United States, moving around the globe like falling dominoes. So, who normally stops prices from collapsing completely? A group called market makers, professional traders who promise to always buy when others want to sell. But during a true panic, even market makers become afraid. They step back, refusing to buy, because nobody wants to catch a falling price. When that last safety net disappears, prices can fall even faster because there is genuinely nobody left willing to buy at any nearby price. Think of it like a game of musical chairs. There are always fewer chairs than players, and when the music stops, someone is left standing. In the stock market, the chairs represent buyers willing to pay a certain price. When everyone rushes to sell at once, there simply are not enough chairs. This is exactly why stock exchanges created circuit breakers, automatic pauses that stop trading when prices fall too fast, too quickly. These pauses give everyone a moment to breathe, allowing panicked sellers to calm down and new buyers time to step in and reassess prices. After Black Monday in 1987, this exact tool was created. Regulators built a three-tier system that pauses trading at 7, 13, and 20% drops. Here's a question most people never ask. During a crash, does the money actually disappear? The honest answer is more surprising than you think. The money does not vanish. What shrinks is the market's total value, because the perceived worth of every share drops at the same moment. Every single trade still has a buyer and a seller. The assets simply change hands at a much lower agreed price than the day before. Your loss only becomes real the moment you actually sell at the lower price. If you hold on paper only, nothing permanent has happened yet. This is exactly what happened after Black Monday. Remarkably, the market began recovering the very next day and regained most losses within 2 years. The central bank also played a critical role. It promised to provide liquidity to the banking system, calming fears of a much deeper crisis. So, what does all of this actually mean for you as an individual investor? It means liquidity is not guaranteed. It depends on everyone else, too. This is exactly why diversification and a long time horizon matter. If you never need to sell during the panic cannot hurt you. The honest truth, markets are built on trust between strangers who never meet. When that trust breaks all at once, prices break with it, temporarily.
Now you understand what really happens if everyone sells at once, and why patience is the one thing panic can never take from you. Subscribe for more.